Going on a model house tour is the first step most people take in pursuit of that great American dream, buying your own home. But as mortgage interest rates began their relentless climb 2 years ago, fewer and fewer prospective buyers came out to browse. Why bother looking, they seem to say. The dream has become a mirage. Builders in Greater Baltimore have cut production in half, victims of the real estate squeeze play. People hoping to trade up to a new home can't sell the one they own, so resales and new sales tumble. First-time buyers take one look at the size of an average monthly payment and decide to keep renting. Many people have decided to simply wait out the high interest rates in the belief that eventually they have to come down. But some real estate experts are now saying that if and when mortgage rates do fall, house prices will probably go up. So realtors continue to preach that there's no time like the present to buy. They point to a variety of affordable mortgages on the market today if home buyers would just start shopping around.
They see the 17%, the 18%, 20%, and they're afraid to even go out and look. They don't know that there's 11.5, 12.5, 13.5 possibly available in some of the new home subdivisions.
So if you had any advice to give a family that really didn't quite have enough money, what would you tell them?
Beg, borrow, and steal.
One struggling young family trying to fight the odds and high interest rates is Ruth and Dave Young and their children, Kathy and Kenny. The Youngs have been working with their agent, Helen Nystrom, for almost a year to arrange financing on this 3-bedroom split level in Edgewood, Harford County. The rent on their 2-bedroom apartment in Laurel is $370 a month and rising. The new house costs nearly $66,000. With Ruth going back to work as a bank teller to supplement Dave's income from truck driving, they were able to put money aside for a 5% down payment. Their joint income of $34,000 easily qualified them for a graduated payment mortgage at 12%. Last December, they signed a contract, hoping that interest rates would fall. Instead, they went up, and it looked like they wouldn't get their house after all. Then the Youngs discovered builder buy-downs, which we'll explain later, and adjustable rate mortgages called ARMs. They've applied for an ARM at 13.25%. After 3 years, it will rise or fall to the going rate. The builder is also helping with the settlement costs.
If the builder hadn't come through with his offer to pay the $2,500 towards your closing costs, what would be happening today?
We would probably be renting a house.
Payments on the new house will be double the Youngs' rent. How will they handle the added expense? What other mortgage plans are available to reduce costs in the early years of a loan? I'll look at those topics tomorrow. This is Fran Fanchel with a closer look. Creative financing. You hear a lot about it these days. Builder buy-downs, seller take-backs, graduated payments. It's a whole new range of ways to help homebuyers get around the high interest rates. If you haven't bought a house in the last few years, you may not know that a revolution has come over real estate financing. The old 30-year conventional mortgages at a fixed rate of interest are a dying breed. Today, homebuyers can choose from a dizzying array of home loans designed to help each individual come up with the hefty monthly payments. The maze of mortgage plans on the market is mind-boggling. Ruth and Dave Young know all about it. Since last December, they've been through 4 different schemes to get around the high interest rates. One of the most attractive was a 14.5% graduated payment plan for first-time buyers. Under that government program, the Youngs only had to put about $1,000 down on the $66,000 split level they wanted in Edgewood, Harford County. Payments would start below the 14.5% rate. During the first 5 years, rates would increase by $273 a month to the full rate of more than $1,000 monthly. If rates fell, the Youngs could refinance. They had to abandon that plan when interest rates jumped to 17.5%. Recently, their realtor came up with another one.
Tonight, I'd like to propose to you another plan, a conventional loan. 30 years at 5% down. I know that's going to be a problem, but I have an answer for that also. Your interest rate would be 13 plus a quarter.
This new plan is an adjustable rate mortgage called ARM. Although not yet widely accepted in Greater Baltimore, many experts say it's the wave of the future. Here's how it works. The Youngs will put $3,300 down. On the $63,000 mortgage, payments will be set at $787 a month for the first 3 years. After that, payments will go up or down for the next 3-year period, depending on where interest rates settle. The Youngs are gambling that by 1984, rates will come down, maybe to 12%. In that case, their payments would drop $60. But if they go the other way, payments as high as $1,000 a month might be possible.
Are you a little concerned about your mortgage rate being adjusted in 3 years and maybe going up?
Well, 3 years is a long way away, and I just hope things get a lot better in 3 years. Yeah, it can only get worse.
What happens if they go up?
Well, we're just trying to rough it a little bit harder, you know. It's been rough coming this far, you know, so we'll just hang in there, try to save every nickel we got, you know, to pay and live in the house, you know.
The Youngs can count on a below-market rate of 13.25% in the beginning because their builder is paying $3,700 in points to his bank to buy down the 17.5% rate. Builder buy-downs eat right into profits.
Yes, that is my profit. Unfortunately, I want to keep my men busy and stay in business for the future, so any builder will do anything to get a sale through these days, even if it means working at cost, because eventually things will get better.
While builders and realtors keep hoping for better days, many financial experts say they're a long way off. Tomorrow, I'll take a look at how borrowers and lenders hope to hang on till then. This is Fran Fanchel with a closer look.